Good morning, ladies and gentlemen. Bonjour, mesdames et messieurs. Don't think I'm going to be doing that all through for every sentence. I won't. Thanks for coming. And this is to welcome you to this very important event. There's interpretation service, 1 English, 2 French. You know what that means. That 2 French, 1 English. Exactly as it is. So please, there's interpretation service, and I want to use this opportunity on behalf of the African Development Bank to welcome you to this very important meeting. Why is it important? Everyone now is talking about the carbon market. How do we get something out of it? What is it? What is in it for us? What is in it for me as an investor? And so this event today is on de risking and scaling carbon market investments in Africa. It's something that is not very well understood. It's something that still needs a lot of work to make us benefit from this market. But today, we've gathered very experienced personalities to talk to us about how Africa can maximize the benefits that the carbon market brings. And at the African Development Bank, we do not miss opportunities that could help African countries to better themselves, to drive their economic growth, to drive their development potentials. And we know that this carbon market, if properly designed, properly implemented, would go a long way in addressing the challenges that Africa and indeed the rest of the world has on climate change. But let me also state that the carbon market is not just about the market. The ultimate goal is to reduce global emissions. So we look at both ways and see how we can ensure that we do not lose out on our resources or earn money where we are unable to spend that money because we are unable to adapt based on the emissions that have been spewed into the world. So on that note, I have the pleasure of inviting Dr. Kevin Karuki, who is the Vice President of the Power, Energy, Climate Change, and Green Growth Complex at the African Development Bank. Like I've always told him, if anything happens to our energy system, he's the man to go to. So, Dr. Karuki, you have the floor.
My remarks will be very brief because I think we need to hear more about this particular process. So good morning, ladies and gentlemen. On behalf of the African Development Bank Group, it is truly a privilege to welcome you to this high-level dialogue on de-risking and scaling carbon market interventions in Africa. We are gathered here today for this crucial conversation to reimagine how Africa can finance its development, how it can monetize its natural capital, and how it shapes the future of global carbon markets. We deem this to be a very timely dialogue because this is where ideas will meet actions, policies will meet principles, and financing will meet Africa's future. In this room, we have a distinguished group, senior leaders from AFDB, governors of the bank, policymakers, CEOs and heads of institutions, development partners, financiers, and representatives of both the private sector and the civil society. But we are united in one important common understanding, and this is that it is imperative that Africa unlocks the vast potential of carbon markets. And why do we say this? It is because despite the continent's natural resource wealth, Africa accounts for less than 3% of global carbon markets. And which is strange because, Tony, we talk about Africa only accounts for 3% of global energy investments, accounts for 3% of global emissions. Looks like we are stuck with this 3% figure, and I don't know whether it's just a bad coincidence. So that, distinguished guests, must change, and it must start changing now. As President Adesina once famously remarked, Africa cannot be resource and nature-rich, yet remain cash poor. This event is co-convened by the bank, the African Development Bank, and our partners, the Glasgow Financial Alliance for Net Zero, or G Funds, and we'll have two key sessions. The first, which is this current session, an opening session, it will focus on the high-level open support for carbon markets, while the second session that will be sort of moderated by my brother, Solomon, will explore the role of Africa financial institutions in the carbon market investments. Largely, over the 90 minutes, we will engage with some key actors and leaders who understand climate finance as an investment, and that carbon markets, if done right, can serve as a bridge between responsibility and economic transformation. We aim to highlight progress, interrogate and address challenges of de-risking investments, while critically charting the path forward for the Africa Carbon Support Facility. This, we expect, will be a very bold instrument that will seek to unlock not just the billions in climate finance, but also the opportunity as well as the dignity of the people of this great continent. With these few remarks, Tony, I think I'll cede the floor to you and wish us all very fruitful and deliberations. Tony?
Thank you. Please put your hands together for Dr. Kevin Kariki. Let me use this opportunity to acknowledge our partners on this event, GFANS, Dr. Becky, any other, just the two high-powered delegates. Thank you very much for coming. Thank you, VP, for those remarks. You've raised very important issues. If you also add the percentage we devote to private sector support, in terms of research and development on climate change is also 3%. The list can just go on and on and on. There's something about 3% in Africa. I think we need to break out of it. So thank you very much, sir. I now have the privilege of inviting one of Africa's most eminent leaders when it comes to these issues of climate change. I've known him for years. You'll join me to welcome Ms. Ibrahima Shekdiong, who has the privilege of being the first executive director of the Fund for Responding to Loss and Damage, popularly called the Loss and Damage Fund. But with over 3 decades of global experience in climate change, finance, and development, he served as special representative of the president of the Arab Bank for Economic Development in Africa on ESG matters, and was previously the UN Assistant Secretary General and Director General of the African Union Specialized Agency, the Africa Risk Capacity Act, which most of us have worked with. Prior to this, he also held several senior positions, including being founder and chair of the Act Afrique Group, senior African banker at BNP Paribas, which many of us know. He was also the minister and Special Advisor to the President of the Republic of Senegal, Director General of the International Corporation of Senegal, Permanent Secretary, and the list goes on and on and on. If I want to read all his biography, we'll be here for a while. So please, you have the floor. Talk to us on how we can work together.
I had to pay a lot of money too for that nice introduction from Tony. Good morning to everyone. Good morning. Good morning. Bonjour. Bon dia. Let me begin by expressing my gratitude to my good friend here, Kevin, for the opportunity to address your meeting today. As the son of Africa and the first ED of this fund that has been in the making for 3 decades, you can imagine how proud I am to be standing here and addressing you as the first ED. But I cannot take the whole credit because Africa has been pushing for this fund for the past 3 decades. And the fact that it has seen the day, it is certainly a testament of what we can do when we come together as a continent. And I recall at the African Climate Summit in Nairobi, the African heads of state were pushing for this. So it's only justice that the first ED come from the continent, and that is why I'm extremely proud to be here. Now, when I was invited to make some remarks, I was trying to find the connection between carbon market and what I do, which is loss and damage. And the connection that I see when you reduce the global emission, we have less losses and damages to deal as a fund, which allows us to focus on some of the priorities of the countries across the most vulnerable nations, as Kevin knows quite well. I want to make a couple of remarks, starting first of all with the problem that we're trying to address. Unfortunately, while we are having this conversation here, extreme weather conditions are not getting better, they're getting worse. Tropical cyclone in Madagascar, a drought in the Horn of Africa, flood in some parts of Africa, and what all these disasters have in common is the human face to climate change. And that is the millions of people who are affected by something that we have not caused, as you say, less than 4%. And this is the reality we're dealing with. And then second, there's also the non-economic losses that have happened across the continent because of climate change. So the big question is, what are the solutions? In my view, it's a combination of different actions. One that I will start with, which is really the result of our fund, is global solidarity. It's extremely critical in addressing climate crisis. Our fund has seen the day because of global solidarity. We were able, within less than 2 years, to set up a fund that has a board, has pledges, but also has an executive director. And that is a sign that when we come together in global solidarity, we can move mountains. And I believe that in the carbon market, with the leadership of the bank, certainly we can get also the global solidarity to work for carbon market in the continent. I think second, it is extremely critical, in my view, to foster complementarity and coordination as we actually respond to this crisis. It is now established, not one fund alone, not one institution alone can do this. So we do actually have to come together, and that is why we at the fund strongly believe that complementarity is the best way to avoid duplication by putting government on the forefront in identifying their needs so we can support them. I think third, we also have to do our part. As a fund, we've decided, from what we've mobilized so far, to launch our early intervention out of $250 million, which will help us to begin supporting countries. And that support will focus entirely on extreme weather conditions in rapid response, slow onset in some cases, but providing grant to countries so they can actually respond rapidly. Now, I'm fully aware that the funding instrument that we require to respond to climate crisis is not grant alone. We need concession financing. We need parametric insurance in some cases. We need at least other products. But what's important here, it's not a one-size-fits-all. It's really important that we make sure we foster all this product so we can deliver. So we, as a fund, we talked the talk and walked the walk and decided to launch our early intervention with the hope that by COP20 we'll begin to make some disbursement and demonstrate the fund has moved from talk to action. Last two remarks I want to make is that for us to respond adequately, we require billions of dollars. As of today, our fund has mobilized $766 million, voluntary contributions, but what we want to be is in the billions of dollars so we can respond to losses and damage. So highly capitalized fund is extremely important for us to meet our demand. But you will agree with me, with the changing landscape of the donor community, it is clear that the usual entrepreneurship as we know it is not going to work. So we need to look at philanthropy, private sector, and other sources of funding so we can mobilize those billions. And I hope with the bank's leadership, wherever that leadership will be, we'll certainly work together in delivering on behalf of the most vulnerable countries. Let me finish by saying this. Our fund has no intention to be on implementing some of the funding that we're providing. And this is where I see the biggest value addition of the African Development Bank, working with the countries we're trying to support so that we can provide the resources, we can co-finance opportunities, we can help countries to identify their needs so that in the end, we can provide them support. So no matter what we say, one thing I want to leave as a message, there's a human face to climate change. We have no choice in leaving no one behind because the most vulnerable people depend so much on us and we can't fail them. So I look forward to your conversation and see how we can work together with African Development Bank. Thank you very much.
He has spoken. You know, the interesting thing about this whole issue is there's a limit to adaptation. While the carbon markets are there to help drive down emissions and possibly earn resources, but there are certain risks you cannot completely absorb. And that's where the loss and damage now comes in there. So there is a very strong complementarity in what we do. He successfully mobilized $766 million. We'll be looking for you for the facility to also raise such money. So please, thank you very much, Mr. Ibrahim. Let me use this opportunity to recognize the presence of Vice President Keno. Is he still here? Yes, sir. Okay. You're welcome, sir. Thank you very much. We have now the privilege of inviting Mr. Paul Muthaura. He's the CEO of the Africa Carbon Market Initiative. He will share his insights on shaping Africa's carbon market landscape. The beauty of what we're doing is we're not just starting from scratch. Things are being done, but we want to bring them together and make them orderly, and so that we can begin to enjoy the economies of scale. So please, it's going to be a video presentation, and set your eyes on the screen. Yes, thank you, colleagues. Okay.
Of critical voices at the 2025 African Development Bank. Thank you. The Africa Carbon Markets Initiative takes great honor in joining this esteemed convening of critical voices at the 2025 African Development Bank Group Annual Meetings. ACMR, with a mandate to scale high-integrity carbon markets in Africa, and our partner, Climate Action Platform Africa, are proud to work with those present at this session and broader stakeholders on the future of carbon markets in Africa. This work will ensure the value proposition of carbon markets on the African continent is being determined by, for, and in Africa. Carbon market solutions, if structured with integrity and impact, can serve as catalytic components of climate-positive growth and development. Africa therefore holds competitive advantage in proactively contributing to global solutions to climate change. Carbon market projects need to be aligned with national priorities and underpinned by transparent, equitable benefit sharing mechanisms that recognize communities not just as beneficiaries, but as essential participants in the development and stewardship of high integrity carbon projects. This accounts for their long-standing and continued conservation efforts that position Africa as a key global natural and technological sink for CO2, noting evolving global realities of climate change. Through a partnership with CAP-A, we have supported governments to develop national carbon market frameworks that integrate Article 6, protect sovereignty, and build trust. In Mozambique, Zambia, Kenya, Nigeria, Ghana, and Rwanda, together with emerging work in Tanzania and Ethiopia. It is central for Africa to define the strategic value of carbon markets within the broader climate positive industrialization. This calls for Africa to be an equal partner at the global standard setting and rulemaking table to ensure the same are responsive to the realities on the continent with no qualification as to integrity and quality. African jurisdictions to leverage the progress under Article 6 of the Paris Agreement and the role of authorization in affirming project alignment to national priorities and appropriate benefit sharing with commensurate pricing. Africa to lead the way in ensuring effective measurement, tracking, and monetization of the outsized socioeconomic core benefits that can flow, particularly on this continent, from appropriately structured projects. Carbon markets cannot scale without foundational investment in policy clarity, data infrastructure, and early stage project de-risking. This is where the African Carbon Support Facility is essential. We commend and welcome this vision of the African Development Bank. ACSF has the potential to crowd in both global and local capital by bridging the financing gap between readiness and bankability. This bridge is essential to local capital delivering context-aware risk and opportunity assessment of project impact. ACME is confident that the AFDB, working together with fellow continental institutions, will nurture the development of cohesive continental practices and standards that cater for distinct national priorities and sustainable development. This will further empower alignment in how Africa defines the terms on which it will deliver mutually beneficial solutions to the global challenge of climate change. Let us seize this opportunity to ensure Africa shapes, owns, and benefits from the carbon markets it helps develop. Thank you, and accept my apologies for not being present.
Thank you very much. That was Mr. Paul Muthara, CEO of the Africa Carbon Market Initiative, one of those initiatives that's funded by Rockefeller Foundation that is taking the bull by the horn to see that there is something right being done on the African market, on the carbon market in Africa. Can we have my presentation? Quickly, it's my pleasure now to take us quickly through the carbon market, just to refresh us, because we have a facility that we are working to establish, and what we're doing is sensitizing people, getting views to make sure that that facility works and works well. But to be able to go there, I have the privilege of taking us through this carbon credits, carbon market, what really is it. I won't go too deep into it, but we have the carbon market we're talking about, which allows investors and corporations to trade. That's the important thing. And what are they trading in? They're trading carbon. And then you also have carbon credits, the actual money or value that you have that is tradable. Not something that you're losing, but a positive asset that you're holding. And then we have carbon offset projects, can be grouped into two generally. We have those that avoid and reduce emissions, like when you talk about renewable energy or methane capture. Then you also have those that remove or sequester, where you have the direct carbon capture, and then you have the reforestation. Examples of carbon credit projects, many of them, about 170. By the end of this year, we are hoping we'll get about over 200, and they have been grouped into about 8 different types. Forestry and land use, agriculture, energy efficiency, and so on. Those are the 8. But incidentally, when you look at most, where Africa is playing the most, it is in forestry and land use and agriculture. But we have a huge potential in other, what happened? We have huge potentials in other sectors or initiatives, let's put it that way. We should not just concentrate so much on forestry and land use. We have 2 types of carbon market. There's something I'm driving at. You have the voluntary carbon market, and then you have the compliance carbon market. In that compliance, you have 2 types. You have the domestic and the international. But when you look at the carbon market in Africa, it's largely looking at the voluntary carbon market. The prices are different. Here, you're selling carbon at about $5 to $6, $7. There it goes as much as $70, $100, $120 per ton. There is a problem there. And so we should not sell the same product, just the change is where did you buy it from? Where is it being sold? That is being sold somewhere else for $6, and another one is being sold somewhere else for $70, $80, $100. When you look at the voluntary carbon markets, it's growing. Market size by 2040 now is about 40 to 2020 is about $400 million, right? That's what we have. And we're saying if we continue the way it is going, maybe by 2040, it will get to about 40 or $115 billion. That's the size of that market. It has potentials for us. I'm not saying we should knock it off completely, but it is there. Then you also have the compliance market. By 2021, it was $850 billion. This year is expected to be about $1 trillion. So why are we locking ourselves basically into the voluntary carbon market that gives us very little when the compliance market is much bigger? So when you look at the graph out there, you see who came in, what China's national program has come in and kicked everything out. The opportunities are there. So we also have that opportunity on the African continent to get a sizable chunk of that market. But things are already happening. We have bilateral agreements based on Article 6.2. You can see several African countries out there that have bilateral relationships, market relationships with some countries. This is good, that things are moving. But the question we want to ask ourselves is, are they getting the optimal part of it? Even if it's bilateral, they are discussing, negotiating. What is it that they would need to get the best? They will need regulatory issues dealt with. They'll need good policies. They'll need good infrastructure. They'll need good amenities to get there. And if they don't have that, if that is missing, it doesn't matter how much you've made. There's a particular country that has been able to sign contracts of about $850 million over the next 10 years. But when you look at it, it looks much. Particularly if you convert it to my currency in my country, it looks huge. That's about $85 million a year. Wonderful. But when you look at it in the grand scheme of things, it's really not best, for us that we could have done this. So we've had where people say they're going to the carbon market to sell. And what is it or to buy? I shared this with Wale yesterday, that in simple economics, we're told payment for ecosystem services. You don't buy the ecosystem. You don't own it. And we want to see how much we can be getting from our forest, from our trees, from our development every year, not just being bought once in perpetuity and off it goes. For those who may not know, it takes about half an acre of mature forest to sequester 1 ton of carbon, or that's CO2 equivalent. And so when we sell that carbon at $6, we're selling half an acre of land for $6. We're selling the trees that stand on it for $6. We're selling the livelihoods of the local communities for $6. We're also selling the other products we would have gotten from those resources, all for $6. And if we break it down that way, then I think you'll understand that we need to do something about it. And that's why we're setting up the Africa Carbon Support Facility. This is a facility that we want to use to see how can we address the imperfections that we have found in the carbon market. This facility is one of its kind because it's the first facility dedicated to helping build that market capacity within the African continent. It will do two things. It has an upstream end and it has a downstream end. This facility is being designed. It's not yet finished. We're consulting extensively to make sure it's not just one of those things that comes in and goes out, that it will stay to solve the problems of the continent. We're also working with the African Union Commission that has a strategy on the carbon market to make sure that it works well. Then it has a downstream facility. And that downstream facility basically, the upstream facility will support regulations, will support policies, will help in setting up the infrastructure, the registries, name them, the capacity building itself to get into that market. Then it has a downstream facility, and that downstream facility will basically be there to provide resources for investors, project developers. What have we seen in the course of this work? That many developers who have projects but do not have the resources to build those projects completely end up selling their estimated or projected carbon assets. And they do it cheaply because they need the money up front to be able to develop their projects and take it to wherever they're going. That's not optimal. We should not see them forced to sell carbon credits, some as low as $3, $2.5, we've seen it, because they need the money. We should be able to ensure that they have the resources for it. It's built on certain pillars like de-risking supply, stimulating demand, being able to build market infrastructure, strengthening policy ecosystems, and crowding in private capital. And that's why we're talking about de-risking, because most times when we talk about capital or investment in Africa, everyone looks at a risk. And that risk is basically a perceived risk, which is not real. So this facility will help to address that. And through this, we envision a future where carbon credits can become a tradable commodity in Africa's stock exchange. We want to get to that point. Like the president said, we cannot be resource rich and poor. This is what we have, and we're going to make the best of it. So on that note, I have the pleasure of inviting Vice President Kariki back to the stage to be able to close this first session and hand over to Vice President Kweno. You're welcome, sir.
The beauty of having a professor speaking to you, he makes things very simple. I mean, if you imagine that you sell your carbon credit for $6, you are selling an acre of mature forest for $6. I think we are doing a great disservice to the continent. And I think this is something that we started talking about 2-3 years ago when we heard and we saw in the media countries selling huge tracts of land, 250,000 hectares or huge tracts of land, for what now sounds like a pittance. So I think as we conclude this session, my role is first of all is to extend our truly grateful thanks to our speakers for their invaluable perspectives, which I believe will provide a very strong foundation for the discussion that will follow. I think what I would conclude, and I think I'm a firm believer in this now, that carbon market development is an imperative for the continent. And this portends transformative potential of the African Carbon Support Facility. And therefore, I think the call to action is very clear. Please join us in harnessing the potential of carbon credits on the continent. And your partnership is absolutely key. We will now transition, as Tony alluded, to focus more specifically on the vital role of African financial institutions in catalyzing investments in carbon markets. The session will be moderated by our partners from GFunds, but I think I'll have to invite my brother Solomon Queno, who will oversee this particular process. Solomon. Oh, but before you just come, I think we also need to take a family picture, I'm told, before some people start disappearing. Thank you.
So we're now moving to the second session. And Tony, thank you very much for the tutorial or the refresher. Clearly your professorial skills are not escaping you. We will not make you a banker. We'll keep you really at the edge of knowledge generation. Now, I've actually been here since the beginning, but when I have to work as a moderator, I try to sit within the audience to really understand who the audience are, to be able to tailor, the conversation to really fit the audience. So I have been here, Tony, even though you thought I wasn't. Okay. So the second panel discussion will focus on the role of African financial institutions in supporting and accelerating investments in carbon markets. It will highlight how these institutions can mobilize the capital and infrastructure necessary to unlock the full potential for developing high-value, high-integrity carbon projects across the continent to support the net zero transition. It will also provide an opportunity for participants to share their perspectives on de-risking and financial instruments to scale up carbon market transactions. So the second session panelists will discuss mobilizing financial resources to overcome the critical barriers to investments in carbon credits. They will also discuss how strategies like blended finance and public-private partnerships can unlock capital to scale carbon projects across Africa. Some of the specific areas we'll discuss include whether de-risking through blended finance and partnerships is crucial for scaling investments. Second, whether regulatory certainty and transparency are key to attracting investors and corporate buyers. Third, whether high-quality carbon credits aligned with global standards will boost investor confidence. Fourth, whether transparency and verification are essential for maintaining trust and long-term market engagement. And then lastly, but it's not exhaustive, whether enhanced cooperation will drive liquidity and scalability in African carbon markets. So my sister Hanan is already here, so I'm not going to walk her up this way. But Hanan is a former colleague at the African Development Bank, but currently the Deputy Executive Secretary and Chief Economist of UNECA. Hanan was really one of the people who made my transition to AFDB in 2020 very easy, especially, Kevin and I joined AFDB during the height of COVID. So we didn't see people, we didn't even see our teams for about 2 years. We saw them through Zoom, but thank you, Hanan. I don't see Boitumelo. Is Boitumelo here? Olympus is representing her. Or Olympus, who's representing Boitumelo, who's the CEO of the Development Bank of Southern Africa, if you could please come up. Even though they have the title Development Bank of Southern Africa, they are actually quite Pan-African. We partner with DBSA. Okay. Then my younger brother, Derek Chime, Chief Investment Officer of the ARM Harris Infrastructure Fund. I like to say that I was influential in Derek's choice or decision in joining ARM Harris as its CIO. Next, I'd like to invite Zeph Kivungi, who is the Africa Climate Director for the Children's Investment Fund Foundation. And then lastly, I'd like to invite the troublesome director for Energy Financial Solutions Policy and Regulations at the AFDB, Wale Shonibari. I say troublesome just tongue-in-cheek. The truth is he's always innovating. And so I look forward to actually hearing. He innovates a lot in terms of what we can do on the local currency side, but I'm looking forward to the innovation around carbon markets, especially given some of the arbitrage opportunities on pricing of carbon credits that Professor has talked about. Okay. So Hanan, I'll change the order and put you on the spot. The primary role of UNECA is to support the economic development of African states. How can African states benefit from the carbon market? What support can UNECA provide to African states in this regard?
Thank you, and it's a great pleasure to be here and with all the dear friends to whom I cannot say no to participate. I think what we're discussing today is a really critical area because Africa has huge potential in terms of ability to meet a third of the carbon sequestration that globally is there, thanks to, for example, the Congo Basin. And yet we are not compensated commensurate to this potential. And with our exposure to all the increased exposure relative to all other regions to climate shocks, this becomes a critical source for funding development, basically. And for us to benefit from it, there is a need to make sure that we have high integrity carbon markets, because currently we are, receiving, less than $10, almost maybe in some cases, around between 5 and 10 per carbon ton, where in Europe it's 120 US dollars for the same, carbon credits. So what we need to do in order to be able to claim higher prices is to ensure that there is higher credibility and integrity of the market. And this is the area that we have been actually supporting. We've been supporting in the Congo Basin in terms of establishing carbon registries, in terms of harmonizing protocols. And that work, and we've also done studies to do mapping of certificates, carbon certificates, to make it easier for private sector to see where are the areas, potential areas for opportunities. So there has been, a lot of work that we've done, and that really kind of attracted interest from other countries and other regions. So we're, supporting countries beyond the beyond the Congo Basin now. However, there are certain areas that I think we need to work on more, which is, beyond helping the registries, the protocols. We need to work on the issues of regional, markets to trade this, regional platforms to trade carbon. And this would be really important, and particularly within the context of the Africa Continental Free Trade Agreement. Another area, if I may, and that I feel we are not getting enough benefits from, is the share of carbon credits, the source of the share, that it tend to be mainly forestry, while there are many actually African countries, number of African countries that have invested heavily in renewables. Yet, we don't see the credits that are related to that. So being not, the environmental economist, not the professor like my dear friend Tony in that area, but in other areas, that was the first thing that I asked my team when I got the breakdown, because I know the countries like Morocco, like Kenya, like Egypt, have invested a lot in renewable energy, yet I have not seen the matching credit. The answer has been, in a number of cases, that this has been integrated in their own nationally determined contributions. And then that raises the question, and maybe this is a perfect opportunity. Given that I have the floor, I can ask questions for our experts here. Why, in planning for that, if we know this is the case, why we were not maybe more conservative so that we can do more and claim credit? So that's one of the things I think that we need to really rethink if this is the case. Thank you.
Okay. No, thank you very much, Hanan. But let me ask you a follow-up question. Wale and I are former investment bankers, so we probably think about arbitrage and so on. You talked about a regional market to trade carbon credits. I would think it should be a global market to trade carbon credits, at least to maximize really the pricing and also liquidity, etc. So why a regional market and not a global market?
You're absolutely right. However, we're not in a fair world, I hate to say. So currently, what we have is, regulations that encourage this trading more within the U.S. market, within European Union, and less, it's less open in a way to cross-border as of now. But I think this needs to change. However, what we need to do is to have this also to, the offsetting, because we have countries within Africa that actually perhaps, that are very low emitters versus higher ones, that basically the ones depending on their level of development. So it helps in setting the standards in terms of what can be done, but also these regional markets can be accessible to other investors. So that's the idea. But definitely, I think it's one of the areas that we need to look into is this opening of markets and regulation. How you do it. Like a lot of these large, entities are more inward looking. And we have to change that to allow actually for us to be properly compensated. Okay.
All right. No, thank you very much, Hanan. And shifting gears from markets to projects, transformational projects that can support carbon markets. Derek, I'm coming to you now. As a catalytic equity investment fund, which is the ARM Harris Infrastructure Fund, especially your fund two, how are you mobilizing investment to support African carbon markets? And you may want to share some experiences. It's not working?
Thank you, Solomon. So, sorry to say, but at ARM Harriet, which is a private equity infrastructure fund, and I think this is similar for most private equity players, the carbon market hasn't been something that we've played in actively, but we've been keeping close to the developments happening in those in that market. I think for us, a lot of the things that you mentioned, warriors around the market, but fundamentally, we always believe that projects need to be fundamentally viable and focus on that. And the reason why we focus on that is that we're in a world where we do not have standardization or the right type of standardization in terms of practices and how you validate and evaluate carbon credit. There's a liquidity issue in terms of the depth of that market, so it's difficult to anticipate and predict. And within the private equity context, you always, to a large extent, want to be able to anticipate or forecast outcomes over the next 5-10 years. Also, talk about benchmark pricing. I think it's fundamental, and I think you touched on it a little bit here, where you talked about we're not getting the proper value being ascribed to carbon credits. If you look at just the disparities when it comes to emissions, you could have an argument around what direction premiums or discounts should go relative to developed markets. And because you're not getting that factored into the pricing, but instead you have a situation where carbon credit pricing is anchored around project risk and the evaluation of project risk. At the end of the day, we are, the carbon market is, and I think as mentioned by an earlier speaker, you're selling a homogeneous product, and that product is not necessarily the carbon credit. That product is the objective behind the market, which is reducing global carbon emission. It's a problem not just for Africans, it's a problem not just for regions, it's a global problem. And that needs to be recognized in how the market is set up. I think overall, this all boils down to market efficiency at the end of the day. And the question is, how do you create market depth and efficiency? You need, at this early stage, a stopgap and a market maker to come into play. And this, I think, is a role best played by DFIs, governments, where you one, there's transparency in terms of how pricing works. There's aggregation with regards to the depth, which drives the depth of the market. And at the end of the day, cohesively, as a region, you can then face the global market and seek fairness, ultimately. I think when you have a market that is efficient and ultimately transparent, you are then able to attract traditional financial instruments to back and support that market and even create more volatility in that market that deepens the market further. But it's difficult for players like myself. It's also equally, I'm sure, difficult for commercial banks or larger financial institutions to adequately price and create an actively traded instrument on the back of the carbon market without having these factors prevalent.
Okay.
Thank you.
Derek, no, thank you very much. I thought you said you're just an observer and not an active player in this market. You almost sounded as educated as the professor. But I'm still going to take you back to projects. You're the chief investment officer of a private equity fund that's in fundraising for Fund 2. And you're getting impact investors who want you to really focus on projects that would reduce greenhouse gas emissions, but yet a return is expected. So as you work on these types of projects, and I know you have a pipeline, how are you going to ensure that you maximize the value of the carbon credits coming out of those projects?
Yes, that's a very good question. So in as much as we don't necessarily price or build our thesis fundamentally on the credit or the trading aspect of it. We definitely drive the activities to articulate what we are doing at the project level, and we try to support the companies in articulating their story to the best extent possible, recording, keeping a track record of the impact that our project could deliver. And ultimately, I think through the focus on these type of projects, we're also able to attract concessional financing into these projects, which accelerates the development of these projects. Now, I think going back to earlier response, there is a lot of activity that has been happening, especially at the onset when it comes to project development, where you are able to get concessional financing at the capital structure level. But I think the market needs to dip in and look beyond that, because after the project is developed, you want that project to continue going on, and I think that's a significant ethos around a sustainable credit market, that we are not just building projects, recording good outcomes in delivering those projects, but actually there's a foreseeable future anchored around our project with regards to carbon credits, the carbon credit market.
Okay, no, thank you, Derek. And given the emphasis on the importance of concessional capital, let me turn to Zeph. Zeph, what is your take on the role of philanthropic capital from institutions like yourself to de-risk and scale investments in carbon markets specifically, or to increase climate finance flows into Africa?
Seems we only have one. Thank you for that. Quickly, starting from why our children's foundation is talking climate. That's a good starting point. We invest to make sure children survive and thrive. And President Odeshina once said, we have to take care of the gray matter infrastructure. If we lose that when the child is young, then we are not recovering it again, and they end up being less productive in the economy and all. So that's the basis. Now, then that means carbon markets for us is not, carbon markets and the whole climate discussion is not a fringe topic, and it should not be for any philanthropy. I see three areas where philanthropic capital can support carbon markets and, by extension, climate finance. The first one is that sort of broader area, the things that don't make business sense, the policies, the plans, the frameworks, which usually some government wants to say, show me where the money is coming from. So they will not see that money unless there is an enabling environment, and it costs money to get that to happen. So whether we are doing sector analysis to understand what kind of assets we are talking about, whether we are doing the gap analysis to see what we are up against, or whether we are, supporting governments to also make sure their national policies are coherent with the global sort of infrastructure. So that's the first area. The second area is what I like to call the capital before the capital flows. So it takes money to develop a carbon asset. It takes sometimes quite a bit. And we are in a market which has either been ignored or just never been developed. So are we talking project preparation? It will cost money. That could be done by the final investor, but he's not going to move in with his team unless they already see some sense as to how that makes a business case for them. So moving projects from the stage where people can start taking positions, whether it's equity positions, whether we are starting to talk about pre-purchase agreements or arrangements, that costs quite a bit. And a lot of time, everybody's waiting for projects to get to that stage, and unless somebody's involved, and that somebody most of the time will be those with higher risk appetite, concessional capital, and that's where the kind of capital philanthropies hold comes in. And the final bit is on the delivery, the implementation. When we look at numbers from the continent, they tend to be projects that have been developed very strongly bilaterally or by people with deep pockets or lazy kind of assets. The rangelands kind of work we see in Kenya or Zimbabwe and then when something goes off or goes wrong, we have a whole issue there. So that delivery part, philanthropy has a role to watch the sort of, for example, the transparency questions, holding the feet to the fire to make sure what you promised is what you're getting. If I'm investing in a project, I'm getting the kind of returns that was agreed in advance. And this is not just the proponent versus the community. It's like a tripartite, if not more. The government has to hold its own responsibility. And to do that is not policing them. It's to make sure that we watch those things before money flows. And then in the kind of measurable side of things, infrastructure like DMRVs, it's not cheap to do that. But then how do you develop DMRV into a vacuum? You need to be part of the project development and thinking about some of those aspects early. There's also issues to do with the data, the tools that are going to ensure that everybody is seeing that they're keeping their part of the bargain. So overall, I would say philanthropy has this responsibility to support the shift from project to project to a portfolio-based approach, from kind of very specific transaction basis to an ecosystem kind of thinking. So you know, if I go to Ghana and we are talking carbon in the area of removals in any of the asset categories, this is what I'm going to expect. That then sends a signal to the market to say, let's go to this kind of set of countries or this kind of set of asset categories, but not to discriminate as we've seen in the current case, because if I'm an investor, I'm going to be selective. I'm going to cherry pick what makes the most sense for me. I don't care what the case is underlying for any other project or any other geography. For me, if I'm an investor, that is what matters. But if you're a community, there's also what matters to you.
Okay. Zeph, thank you very much. That was very insightful. First of all, trying to understand what a children's investment fund is doing in carbon credits was I think, at least for me, when I was taking a look at the notes that Tony sent me, was a little perplexing. But it's you know, it's great to hear you guide us to where philanthropic capital would want to play, which is not project by project, but really a portfolio approach. And then in addition, more to build the ecosystem and infrastructure. Now, there are a lot of financiers here who are looking at, we use the language of capital stack, the blended finance multi-tranche structure, where we need the grants and the concessional capital. You've given us some guidance, but if you could just touch a little bit on the concern that we have, or we hear that philanthropic foundations and so on have about subsidizing private sector. If you could talk about that briefly.
Yes, and I think that's where the ACSF comes in. To create a systemic mechanism that allows for that capital to flow, again, not from project to project, but a very systemic sense. So the way we would want to look at that is to say, what would it take for philanthropic capital to flow once and create an environment that does not require them to come to every transaction? Because in the grand scheme of things, philanthropy is the smallest sort of capital holder. The deepest pockets are in private sector, in government. So the role would be, because the capital is so limited, what is it we do to create a long-lasting piece of infrastructure or process? So that's why supporting a facility like what the bank is working on is an important consideration for philanthropy. Get involved in that space, establish all the thought processes that are required so that they can be applied many times. This concept of capital, recycling is more important to us because our capital is very limited. And we don't want to just spend and then that's gone. We want to invest and say, we participated in creating the foundation of this infrastructure, and we are glad that it is now doing what it was supposed to do.
Okay, no, thank you very much, Zeph. So now I move to the development bankers, and let me start off with DBSA. So please provide an overview. We understand you've established an infrastructure fund, which would be the center of excellence in blended finance solutions. So if you can tell us more about how the fund, would or could support carbon projects in Africa.
Thank you very much. And I would like to start by apologizing on behalf of the CEO for not being here. I think for us, this is a very important topic. Is that audible now? Thank you very much. Yeah, I think for us, from a DBSA point of view, this is a very important topic. The focus from a country point of view, talking about South Africa, has really been trying to kickstart economic growth. And infrastructure is seen as an important contributor to that. And I think that is what informs the infrastructure fund that you're asking about and how it operates. And what we're really trying to do with the infrastructure fund is really creating a blended facility platform where you are able to pull in various sources of funding, including from the fiscus, using that to crowd in a private sector and other sources of financing to be able to deploy infrastructure at scale. What is clear, however, is that if you are thinking about doing this in a way that climate-proofs infrastructure, you really need to be looking at different sources of financing beyond what we traditionally look at. And that is why carbon markets are quite key. And I think what has been helpful from a country point of view has been, from a regulatory point of view, the having in place a carbon tax that really drives the compliance side of the market has been quite critical. Yes, starting at a low base where the tax rates are low just to help industry to take up, but gradually increasing, while at the same time giving the market an opportunity to respond. I think that has been quite a key. And together with that, the promulgation of the Climate Change Act, which clearly defines carbon budgets and sectoral emission targets, plays right into that, creating, I believe, a useful, enabling environment. But then on the voluntary market side, then you have players like your Johannesburg Stock Exchange, putting in place platforms from a trading point of view, which works more or less like a matching facility between potential, the demand side and the supply side of the market. And I think that has been quite useful. From a DBSA point of view, I think we have recognized the importance of really accelerating our involvement in the market. And in doing that, we are currently developing a framework. And the framework that we are really developing seeks to really catalyze the market in as best as we can. And there's a number of things that we are looking at. But what we found key is support, especially from a project preparation or project development point of view. And I think the professor earlier mentioned something important, that if you are developing this market and you don't know what you're doing, you're likely going to end up selling yourself less. And we see that as quite important, that we can be able to intervene, even to provide project preparation support, so that your project developers are not desperate to an extent that they sell for less because they do not have the resources to develop their projects. So we see that as an important intervention from a development finance point of view to catalyze the market, to develop capacity and skills in the market. So that is the thrust of what we are looking at in developing the framework from a DBSA point of view. And we are really quite excited to see the initiative that AFDB is working on, and would look to plug into that to enhance the work that we do. Thank you very much.
No, thank you very much. I mean, you stepped in. Oh, you were about to give him a hand. Go ahead. Yeah. Okay, yeah. You stepped in for Boitumelo. We were together in the meeting with the regional economic communities and the African DFIs, and that run late. But you stepped in so quickly and you've responded so cogently, so thank you for that. And I like the way you ended, which is it's about partnerships, and DBSA would look to find a way to plug into the African Carbon Support Facility. Great, thank you. Is that Olympus? Yes, thank you. Thank you, Olympus. Mr. Shonibar, you're an energy specialist at the African Development Bank, but you are also one of our most innovative minds. So I know you're not going to just share with us what is traditional, but you give us some ideas. So how do you see multilateral development banks like the AFDB supporting the de-risking and growth of Africa's carbon markets? Is there an opportunity to use carbon finance and carbon markets to achieve the M300 goals? I know you would want to naturally speak about the African Carbon Support Facility, but please feel free to expand beyond that. Wale.
Yeah, thank you very much, Solomon. I'm a bit puzzled by what you called me, the troublesome director. I hope I'm not going to acquire that reputation, especially given that we have a new president coming in. Is that troublesome director?
No, but I attached...
So we're going to keep that within this room, eh?
I attached troublesome to innovative. So,
okay,
yes,
good. Say innovative. Anyway, well, thank you for the opportunity. I think when it comes to carbon markets, there's been a lot of hype. And we have to separate the hype from the reality. I mean, if you go back to 1997, when the Kyoto Protocol was introduced, there was a lot of excitement. You had the Clean Development Mechanism, which was operationalized between 2007 and 2015. And what happened at that time, you know, when project developers came to me and said, look, we're going to use carbon markets, carbon credits to fund our projects, it was the whole process. Can I rely on this revenue? Because bankers don't take demand risk. You know, you want certainty around your revenues. And CDM, unfortunately, was discredited because there was double counting. People could not rely on those revenues coming in. And that's why when we had the Paris Agreement in 2015, COP21, everybody thought, okay, we're going to reset so that we can rely on these carbon credits. But Article 6, which is absolutely critical to the carbon credits, was not agreed in 2015. Now, it took almost 10 years, 2024, COP29 in Baku, for Article 6 to be eventually operationalized. And that was quite a paradigm shift, which we didn't celebrate enough, because under Article 6, finally, you're going to have, you know, an international registry that is backed by the UN. The carbon credits can be authenticated. You can rely on them. And then we can start to innovate because we're clear around the authenticity of these carbon markets. Because what's happened is we've tried to do a bit on the voluntary market, which is what we've been doing in Africa. But globally, the total voluntary market is only $2 billion. I mean, what's $2 billion? When we did M300, the first 12 countries that submitted their national compacts submitted requirements of $126 billion to achieve their M300 goals by 2030. So if we're serious about generating the kind of money that we need to make an impact, then we have to look at the compliance markets, because the compliance market is more credible, right? And that's why you're asking the difference between, oh, carbon is $5 in Africa, and then in Europe, carbon is $100, or carbon is, much more valued in Singapore, because these governments have established emissions trading systems within a closed market. And so you cannot trade your carbon credits from Africa, where we don't have the proper verification, the proper governance, the emissions trading systems, the monitoring, in a market that is highly controlled, like California, like the EU. So when you govern properly, when you establish those mechanisms, then people trust the carbon credits. In Africa, you have these verification agencies like Gold Standard or Vera, who unfortunately have seen some controversy in recent years. Some of the forestry projects were questioned, that the level of carbon credits that they were claiming. So as a banker, I want to be sure that the value of the carbon credits that I'm getting in my cash flow is going to be delivered. And that's why, for me, I see the real opportunity in those more regulated compliance markets. That's where the money is going to come from. And those markets are, in the trillions of dollars. So, but once we have that, the opportunity to innovate is certainly there, because then you can securitize the revenues that you're expecting, raise money today based on revenues you can get tomorrow. We can set up funds where we put in like a first loss layer in anticipation of carbon credits that will come in, because many of these carbon credit projects in clean cooking, for instance, are very small projects. So you want to set up an aggregator. With the aggregator, you have revenues coming from different areas, you have an intermediary, and within that aggregator fund, which we're actually working on at the bank on one of the transactions, where we have trust fund money from CEFA acting as a first loss, and then you have the more commercial funding, and they will have that buffer in case the carbon credits don't materialize, because there's still some operating risk there that you have to protect. So that's the kind of thing. And then we've also been approached by some operators who are saying, look, we need money to be able to expand. Clean cooking is a big issue in Africa. So if you're doing clean cook stoves, you want to be able to expand as quickly as possible. While the verification is going on, you want a carbon prepayment mechanism. So we can also look at that, and I'm very excited about the ACSF that is being established by Tony's team, because we can use that to prepay for carbon credits. I was saying to one client, look, if I prepay for your carbon credits and I buy it from you at $10, and you eventually go and sell it at $20, am I going to get a profit share? So we decided, okay, maybe we meet in the middle. I get half of the upside, so that I use it to replenish my fund, so that that fund can be sustainable. Because you don't want to be going cap in hand to donors each time. You want to set up something that is sustainable. So, and we can also provide a minimum floor price, for the carbon credits. Again, we will share in the upside. If you go below the floor price, we will pay out, for the difference. But if you go above the floor price, then we claw back some of the upside. So these are some of the innovative opportunities there are, but I need to believe in the carbon credits, and that's always been the problem, the verification, the integrity, and the governance mechanisms around those carbon credits.
Okay, as you can see, I told you, innovative mind. Okay, no, thank you very much, Wale, for that. In fact, Kevin, you remember we've been talking about the warehouse facility, a warehousing facility where, you know, not just ourselves, but also the MDB system come and essentially provide that prepayment structure and then share in the upside, because we have the ability to really influence around, you know, the governance framework and the whole, trying to create the integrity of the carbon credits. But Wale, I'm not going to let you off completely. You've given us a fantastic response, but Kevin will kill me if you don't talk about how carbon credits could support the M300.
Okay. I can't escape from M300. Everywhere I go, everybody is asking me about M300. Okay, fine. M300, as you know, is the initiative by the World Bank and the African Development Bank to provide energy access to 300 million Africans by 2030. That's half of the 600 million currently without access. So there are 5 key pillars within M300, but the ones that relate the most, they're absolutely critical. Obviously, we want to drive distributed renewable energy, and that's largely renewables. You know, so renewables, when we have renewable energy, that's mitigation. We're avoiding emissions. So the carbon avoided can be verified and translated into carbon credits. Clean cooking is a very critical part of Mission 300 because you have close to 900 million Africans without access to clean cooking. So all these clean cook stoves, electric cooking, electric cook stoves, those are absolutely critical, and there you're saving a lot of emissions. You know, so again, as we roll out Mission 300, where we have projects where you're avoiding and you have mitigation outcomes, these are things that can now be translated into carbon credits. And we're also aligning Mission 300 with the nationally determined contributions of the countries. I mean, these are agreements countries have entered into under the Paris Agreement as their path towards achieving net zero. So if those projects are within the NDCs, again, with the Article 6.2 and 6.4 of the Paris Agreement, then you can start to harness the carbon credits. So I see Mission 300 as being perfectly complementary to what we're trying to achieve. And the carbon credits that we're able to crystallize will also form part of the financing package.
Great. No, thank you very much, Wale.